Picture this. It's the year 2000. The internet's on fire, stocks are skyrocketing, and everyone's riding the wave of prosperity. Fast forward to 2011, and the S&P 500's return? A big fat zero. 11 years of dreams vanished. Now, in 2024, we're seeing some eerily familiar signs. But what if there's a way to avoid repeating history? In this video, we'll uncover how some savvy investors grew their wealth even when the market flatlined. We'll also touch on the Magnificent Seven and their role in today's market. Don't miss these crucial insights that could reshape your investment strategy and potentially safeguard your financial future. Have you ever heard of the Magnificent Seven? No, we're not talking about the classic Western film. In the world of finance, the Magnificent Seven refers to a group of tech giants that have become the darlings of Wall Street. Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. These 7 companies now make up over 31% of the S&P 500's total value. This level of market concentration is unprecedented in recent history. The last time we saw something similar was 28 years ago when the top 7 stocks made up about 22% of the S&P 500. Today, it's a staggering 31%. If we expand our view to the top 10 companies, they comprise nearly 40% of the index, with 9 out of these 10 being in the technology sector. While these companies are incredibly successful and innovative, this concentration poses significant risks for investors. Think of it like building a house of cards. As you add more cards to the top, the structure becomes taller and more impressive, but also more unstable. One wrong move and the whole thing could come tumbling down. This risk became painfully clear during the dot-com crash of the early 2000s. When tech stocks plummeted, many investors who were heavily concentrated in these companies saw their portfolios devastated. It's a stark reminder of the dangers of overexposure to a single sector or group of companies. The rise of artificial intelligence has been a major driver of growth for many of these tech giants. AI has the potential to revolutionize industries and create enormous value. Companies like Nvidia are providing the hardware necessary for AI development, while others like Google and Microsoft are integrating AI into their products and services. This technological edge has fueled their rapid growth and market dominance. However, AI is still a relatively new and untested technology. We're in the early stages of AI revolution, and it's unclear how it will play out in the long term. This uncertainty adds another layer of risk to the market's current concentration. So what does this mean for you as an investor? While the Magnificent Seven may continue to thrive, relying too heavily on them could expose your portfolio to significant risk if market conditions change. It's crucial to maintain perspective and diversify your investments. Remember, the market has a way of humbling even the mightiest of companies. Just think back to once dominant forces like General Electric or Kodak. The Magnificent Seven have earned their place at the top through innovation and execution, but as an investor, it's important to stay vigilant and balanced in your approach. Let's talk about a financial tool that's been raising eyebrows on Wall Street, the CAPE ratio. Imagine it as a speedometer for the stock market, showing us how fast or expensive things are moving. Right now, that speedometer is in the red zone, telling us the market is more expensive than it's been 98% of the time in the last 125 years. So what exactly is this CAPE ratio? It stands for Cyclically Adjusted Price-to-Earnings Ratio, created by Nobel Prize-winning economist Robert Shiller. It's like a financial thermometer that measures how hot or overpriced the market is over time. Here's where things get interesting. Today's CAPE ratio is sky high, rivaling the levels we saw during the dot-com bubble. It's as if history is repeating itself, but with a new cast of characters. Our Magnificent Seven tech giants leading the charge. You might be thinking, but these companies are different. They're changing the world. And you're right, they are. But remember, every bubble in history had its own "this time is different" story. When valuations get this high, it often spells trouble for future returns. Let's break it down with some numbers. When the CAPE yield, the inverse of the CAPE ratio, is as low as it is today, around 2.6%, history shows that the S&P 500 has struggled to produce positive returns over the next decade. We're talking average annualized returns between 0.5% in nominal terms and negative 4% in real terms. That's a far cry from the double-digit returns many investors have grown accustomed to. A study by J.P. Morgan covering 27 years found that buying the S&P 500 at a P/E ratio similar to today's resulted in 10-year returns between plus 2% and minus 2%. Imagine putting your money in a market for a decade and potentially ending up right where you started, or worse, with less than you began with. Now you might be wondering about AI. Isn't that going to change everything? It's true, artificial intelligence has the potential to revolutionize industries and drive growth. But the market has already priced in a lot of these expectations. The question isn't whether AI will be transformative. It's whether it will be even more transformative than what's already baked into these sky-high valuations. Here's the kicker. Markets tend to revert to the mean over time. It's like a rubber band. Stretch it too far and it snaps back. The further we get from average valuations, the stronger the potential pullback. This doesn't mean a crash is imminent, but it does suggest that future returns might be lower than what we've seen in recent years. So what does all this mean for you as an investor? Should you panic and sell everything? Not necessarily, but it does mean you should be cautious and think carefully about your portfolio allocation. Diversification becomes even more critical when valuations are this high. Imagine walking into a store where everything is priced at double its actual value. That's essentially what's happening in today's stock market, according to a key metric called the price-to-book ratio. This ratio, which compares a company's market value to its book value, is now higher than it was during the peak of the dot-com bubble in 2000. But before we jump to conclusions, let's break down what this really means for your investments. The price-to-book ratio is like a price tag on a business versus what that business is actually worth on paper. Historically, when this ratio gets too high, it's been a warning sign for overvalued markets. Right now, it's not just high, it's breaking records. However, the story behind these sky-high valuations isn't as straightforward as it might seem. The market has changed dramatically since the early 2000s. Back then, tech companies were mostly valued based on their physical assets. Today, the most valuable companies often derive their worth from intangible assets like patents, brand recognition, and proprietary software. Take Apple, for example. While they have factories and stores, their true value lies in their brand, ecosystem, and intellectual property. These intangible assets don't appear on the balance sheet like a factory would, but they're incredibly valuable. This shift towards intangible assets is challenging our traditional valuation tools. The price-to-book ratio might indicate overvaluation, but it's not capturing the full picture of a company's worth in today's digital economy. Does this mean we're not in a bubble? Not necessarily. While the rise of intangible assets explains part of the story, it doesn't account for everything. Many sectors still show worryingly high valuations, even when we factor in these new types of assets. For investors, this means a few things. First, don't panic. High valuations don't guarantee an imminent crash, but they do suggest that future returns might be lower than recent years. It's a reminder that diversification is crucial. Consider looking beyond the usual suspects in your portfolio. Maybe explore sectors that aren't as heavily reliant on intangible assets, or look at markets outside the US where valuations might not be as stretched. Remember, successful investing isn't about chasing the highest flying stocks. It's about building a resilient portfolio that can weather different market conditions. In times like these, when traditional metrics are sending mixed signals, that resilience becomes even more important than ever. When markets plummet, it's natural to feel panic. Your heart races, palms sweat, and you're tempted to sell everything. But even during the dot-com crash, some savvy investors saw their wealth grow. It's a powerful reminder that panic isn't always the best response to market volatility. Let's consider the big picture. History shows that staying invested during downturns often leads to better outcomes than trying to time the market. It's like trying to catch a falling knife. Dangerous and ineffective. Instead, successful investors find opportunities in challenging times. From 2000 to 2011, while the S&P 500 barely moved, U.S. small value stocks delivered an impressive 9.27% annualized return. It's a perfect example of how different market segments can thrive even when the broader market struggles. You might think, but this time it's different. Every market cycle is unique, but our emotions often lead us astray. Fear and greed are powerful forces that cloud judgment. Think of it like driving on ice. Your instinct might be to slam the brakes, but experienced drivers know to steer into the skid. Investing during turbulence requires a steady hand and a clear head. Historical examples show the benefits of staying invested. After the 2008 crisis, those who held on or bought more saw their portfolios recover and thrive. The S&P 500 had one of its longest bull runs in history. Even in today's high valuation market, opportunities exist. European stocks currently trade at less than half the CAPE ratio in US stocks, potentially offering value for those looking beyond their home market. The key isn't predicting crashes or finding hot stocks. It's building a balanced, long-term approach. This strategy has historically provided protection and returns for retirement planning, especially during turbulent times. Over the past 25 years, a balanced, factor-weighted equity portfolio has outperformed the S&P 500, offering better protection for retirees during volatile periods. For investors, this means caution is warranted, but panic isn't the answer. Focus on building a diversified portfolio that can weather different conditions. Look for overlooked opportunities. Most importantly, keep your emotions in check. Your future self will thank you for staying calm in market storms. Did you know that a diversified portfolio can outperform a single market strategy by a significant margin? Since 1971, international stocks have outperformed U.S. stocks 100% of the time when U.S. returns were below 4%. This striking statistic highlights the power of diversification in investing. Diversification isn't just about mixing U.S. and international stocks. It's about creating a balanced portfolio that can weather market storms and potentially boost your returns. Think of your portfolio as a symphony orchestra. The violins might represent large-cap U.S. stocks, while the cellos could be international stocks. The woodwinds might be small-cap stocks, and the brass section could represent bonds. Each section plays its part, but it's the combination that creates a harmonious performance. Let's look at a real-world example. During market downturns, a diversified portfolio including U.S. stocks, international stocks, bonds, and other asset classes can often perform better than a portfolio focused solely on one market. This shows how diversification can help cushion your portfolio during turbulent times. A balanced, factor-weighted equity portfolio that includes a mix of U.S. and international stocks, small and large companies, and both growth and value stocks has outperformed the S&P 500 over the past 25 years. We're talking about a 9.18% annualized return compared to the S&P's 7.83%. Over time, this difference can lead to a substantially larger nest egg. So how do you start diversifying your portfolio? Here are some steps to consider. 1. Look beyond U.S. stocks and consider adding international exposure. 2. Include a mix of large-cap and small-cap stocks. 3. Balance growth stocks with value stocks. 4. Don't forget about bonds for stability and income. 5. Consider low-cost index funds or ETFs that offer broad market exposure. Remember, the goal isn't to eliminate risk entirely, but to manage it intelligently. Diversification can help smooth out your overall returns and reduce the impact of any single investment's poor performance. One key to maintaining a diversified portfolio is rebalancing. This involves periodically adjusting your investments to maintain your target allocation. It might feel counterintuitive to sell some of your best-performing assets and buy more of the underperformers, but this discipline can help you buy low and sell high over time. By embracing diversification, you're not just spreading risk, you're potentially setting yourself up for stronger, more consistent returns over the long run. It's a powerful strategy that could make a significant difference in your financial future. However, a word of caution. Diversification doesn't mean blindly spreading your investments across every possible option. Over-diversification can lead to mediocre returns and unnecessary complexity. The goal is to find the right balance, Enough diversification to manage risk effectively, but not so much that you dilute your potential returns. Picture this. You wake up one morning and your AI assistant has not only scheduled your day, but also optimized your investment portfolio. Sounds like science fiction. Well, artificial intelligence is rapidly becoming a reality that's reshaping our world and the stock market. Let's explore how AI is driving growth and speculation similar to the internet boom during the dot-com bubble. AI is already making waves across industries. In healthcare, it's assisting with disease diagnosis and drug discovery. Financial institutions use AI for fraud detection and algorithmic trading. Even manufacturing is seeing AI-powered robots streamlining production lines. This technological revolution is why many investors are bullish on the U.S. economy, viewing AI as a tailwind allowing companies to boost productivity and profits. But here's where it gets interesting. AI's potential could make even overvalued companies worth their astronomical price tags. Take Nvidia, Google, and Tesla, for example. These tech giants, seen as well-run and connected to the current administration, might justify their sky-high valuations if they continue to grow significantly. However, the AI boom isn't without risks. Not all companies or sectors will benefit equally from AI adoption. We're still in the early stages, facing technical hurdles and ethical concerns. Plus, governments worldwide are grappling with AI regulation. A sudden policy shift or international tension would dramatically impact AI-focused companies. So what's an investor to do? The key is balancing AI's potential with risk management. Consider tilting your portfolio towards areas with higher expected returns, but be wary of over-concentrating in high-value tech stocks. The principles of diversification we discussed earlier still apply, even in the age of AI. One strategy is to invest in a mix of established tech giants and smaller companies working on AI applications. This approach lets you ride the AI wave while spreading your risk. AI-focused ETFs are another option, providing exposure to a range of companies in this space. Don't forget to look beyond tech. Industries like healthcare, finance, and manufacturing are poised for significant AI-driven transformations. Investing in these sectors could offer a more balanced exposure to AI's potential. As you navigate this AI-driven market, stay informed about potential regulations. Keep an eye on discussions about data privacy, algorithmic bias, and AI safety standards. These could significantly impact the trajectory of AI companies and your investments. Remember, while AI promises a bright future, it's crucial to approach it with a balanced perspective. By understanding both the potential and the risks, you can position your portfolio to capitalize on this technological revolution while maintaining a solid foundation of diversified investments. Meet Sarah, a 35-year-old software engineer who's just starting to think seriously about her financial future. She's heard about the potential of AI and wants to create an investment strategy that's both smart and forward-looking. Sound familiar? Let's walk through how Sarah can build a resilient, AI-aware portfolio. First, Sarah needs to assess her current financial situation. She's saving for a house down payment in 5 years and thinking long-term about retirement. Her risk tolerance is moderate, given her stable job but relatively short-term house goal. With this in mind, she can start crafting a diversified portfolio. Here's a step-by-step approach Sarah can follow. 1. Start with a core of low-cost index funds or ETFs that provide broad market exposure. This could include a mix of U.S. and international stocks as well as bonds. 2. Add a layer of sector-specific ETFs, including technology and AI-focused funds. Sarah can research these by looking at her holdings, performance history, and expense ratios. 3. Consider individual stocks of companies leading in AI development or implementation. Sarah should look at their financial health, competitive position, and potential for AI-driven growth. 4. Allocate a small portion to more speculative AI investments, like specialized AI startups or venture capital funds, if her risk tolerance allows. 5. Balance this tech exposure with investments in sectors that might benefit from AI adoption, like healthcare or finance. Sarah sets up automatic monthly investments to take advantage of dollar-cost averaging. This helps her navigate market volatility without trying to time the market. Now let's talk about maintaining this portfolio. Sarah schedules quarterly reviews to check if her investments are still aligned with her goals. Here's what she does. 1. Compares her current asset allocation to her target. 2. Rebalances if any category has drifted more than 5% from its target. 3. Reassess her AI-related investments. Are they still at the forefront of innovation? 4. Considers any life changes that might affect her strategy. Sarah also sets an annual deep dive to 1. Research new AI developments and their potential impact on various sectors. 2. Evaluate the performance of her AI-focused investments against broader market benchmarks. 3. Adjust her strategy based on changing market conditions and personal goals. Remember, building a resilient, AI-aware portfolio is an ongoing process. It requires patience, continuous learning, and the flexibility to adapt as technology evolves. By following Sarah's approach, you can create a strategy that's not just prepared for the AI revolution, but positioned to potentially benefit from it. As we wrap up our journey through today's market landscape, remember, history rhymes, not repeats. Signals echo past bubbles, but don't guarantee a crash. Your best defense? A balanced, diversified portfolio tailored to your goals and risk tolerance. Investing is a marathon, not a sprint. Patience beats chasing hot stocks or panicking during dips. The tortoise often wins in the long run. Your next move? Stay informed, stay calm, and keep investing for the long term. Review your portfolio and make adjustments if needed. In our next video, we'll explore reasons to never, ever retire, even if you can. It's sure to be eye-opening. So, are you investing for the long haul or just riding market waves?